Hello and welcome to DIY Investing YouTube channel. Today we are covering Intuit Inc. ticker INTU. Over the next few minutes, I'll discuss my thoughts on the valuation of this company and its business quality. Intuit operates in the software industry. They have a market cap of $155.6 billion, $158 billion in enterprise value. So you see only about $2 billion in net debt on this business, which is basically immaterial at about 1 to 2% of the overall enterprise value. So not a lot of debt here. So enterprise value here we have business description. They provide financial management and compliance products and services for customers, small business, self-employed, accounting professionals in the U.S. So they have 4 segments: small business, self-employed, consumer, Credit Karma, and pro tax. So small business and self-employed provides QuickBooks services. I'm a user of this service myself. MailChimp services. They also have QuickBooks Online services. Self-employed solutions as well. Consumer has TurboTax, so that's their big brand name product. Income tax preparation product and services. Credit Karma is a personal finance platform, and the Pro Tax segment provides Lacert, Pro Series, and Profile desktop tax preparation software products, and Pro Connect. So I'm assuming these are targeted towards more of the accounting professionals as well. Overall, these sounds like a pretty good business model as it is so far. Again, I'm a user of both the QuickBooks and the TurboTax software myself. I find them to be very useful. Really interesting business to have that as the software side. Now, return on invested capital, we can instantly see that they've been profitable every year from 2002 to 2023. So you see 20 straight years or more of profitability. That's a very positive sign of a high quality business. Likewise, when we look at the actual return on invested capital numbers, there's a few things that we notice. The first thing is they're actually really strong numbers overall: 16%, 16, 21, 24, 18, 15, 13. It's noticed that they bottom at 13 in 2009. So they are a little bit worse off in 2009, but between 24% and 13%, both numbers are very strong double-digit numbers. Then you get back up to 23, 23, 23% in this 2012 to 2014 timeframe. 1 year drops to 11%. You get up to 52% by 2018, and we've fallen off a little bit since then, down to about 11 and 9%. Still, overall, pretty strong numbers from a return on invested capital mark. I'm going to guess that maybe some of this fall off is maybe an acquisition in this time frame. We'll have to double check because you do see a big jump in revenue from 2021 to 2022. And so I don't really know what that is. But overall, still very strong numbers for return on invested capital. Definitely a high-quality company. That's affirmed when we look at these 10-year median returns, which are just amazing. These are world-class results: 26% return on invested capital, 34% return on equity. Very attractive results that are immediately interesting to me as a potential shareholder. Gross profit margins here of 82%. Anytime you see above 80%, that's astounding. This is pretty common for something that's like in the software industry, but overall, very strong margins. They're getting a lot of incremental. When they get incremental revenue, that money is falling to the bottom line at a very strong rate. I like what I see there. Now, we see that the revenue has grown at 13.8% over the last 10 years. Assets have grown at 17%. Now, the fact that those assets are growing faster than revenue is a large reason for the decline in return on invested capital over the last 10 years. So if we go back 10 years, you were at around a 23% return on invested capital. That's dropping down to basically 10% in the most recent years. Now, 10% is still very, very good. I like 10% returns on invested capital. You can get to a nice 14, 15% return on equity with those numbers, which you see down here at the bottom. So very strong and respectable results there, but you don't want to see assets growing faster than revenue over the long term. That's not something that's super attractive. Likewise, I'm not a big fan of the fact that EPS is growing slower than revenue. Typically, I want to see operating leverage, which means revenue maybe grows at 13%, but maybe EPS grows at 16%. And that little boost there from operating leverage would be ideal. Now, part of the reason for not having that, I think, is the fact that our gross profit margin has declined. We were at 85%. Now we're down to 78%. And your operating margin has declined as well, 30% down to 21%. Now, the big drop off appears in at least the operating margin in 2021, 2022, which is maybe an acquisition. You drop from 26% down to 20%. So there's a big change here. You can see the operating profit did not move, even though the revenue went up 30%. That's really abnormal. Your EPS actually dropped down during that time frame. But what I do see is we've been profitable each and every year here. We're maxing out here with $8 in earnings in 2023. Now, The big problem for this company, because this is definitely a very high quality business, we're talking world class, definitely trending towards being a watch list stock for me. The problem becomes, what price am I willing to pay for this company? We're getting really good dividends. So you see dividends paying out very well, probably a third, 40 to 40% of your money is being paid back to you in dividend. That's a strong number. The problem is we see this dividend is $3.12, but the share price is $556. So despite having a very strong dividend payout on our earnings, we're still having a dividend yield of less than 1%. The price is just too high. We see P/E here of 65, price to sales of 10. These prices are completely unreasonable for paying. You don't deserve those prices on a revenue growth of 13%. You certainly don't deserve those prices when your assets are growing faster than revenue and your EPS is growing slower than revenue. So I think the company is clearly overvalued here, but would become a lot more interesting if the PE ever got down to the 20 range. Now, that would require a 2/3 decline in the stock price from 556. So we're basically talking, I want the stock price to be below $200 a share. If I can get the stock price under $200 a share, it starts to become interesting. But for now, this is trending towards a watch list stock, so I would wait for maybe a more attractive price. Maybe during a recession, we could get a really interesting price on this business. It seems like a very strong business. Now, let's learn a little bit more by going into the income statement next. If you're learning something from this video, hit that like button. Don't forget to subscribe. Let's go to the income statement now. Okay, so we get big jumps here. We're sustaining those revenues. Trailing 12 months is matching 2013 here. SG&A. Did we have a big jump in SG&A with the revenue? We do. So big jump in SG&A here. Big jump in R&D. I want to say they made an acquisition here in 2021 based upon these numbers. We'll see that when we get to the next statement. You saw a little bit of a jump in shares outstanding and again in 2022. So overall, though, across the decade, we can see that, not a lot of shares have been taken out. They took out a lot of shares over a 5-year period here from 2014 to 2018. They cut out about 10% of the shares outstanding from 291 to 261, but then it's gone back up to 283. So across the decade, we are down shares, but it's basically flat. It's not enough to even say that you've had a 1% boost per year from buybacks. You have had some buybacks. They've not really been effective overall because you've actually given some shares back. So nothing of note there. Let's go to the balance sheet. See if we can see goodwill take a jump. We do. So it looks like 2 years in a row they made acquisitions here. From 2020 to 2021, you see the big jump in goodwill from $1.6 billion to $5.6 billion. $4 billion in additional intangibles there. $3 billion added here. You then jump again with another $8 billion in acquisitions, $4 billion in acquisitions here. So you get $12 billion in acquisitions there. All of these acquisitions are what's tanking the return on invested capital. So really, if we go back to 2020 before these acquisitions, you get a 28% return on invested capital. You make those big acquisitions, it's going to pull down the return on invested capital. Now, because that's going into goodwill and it's not requiring a lot of new PP&E is only up triple over this time period. It's not a huge jump in your PP&E. A lot of this is your intangible assets. So you went from a business where you had $6 billion in assets to $27 billion in assets. That's going to collapse your return on invested capital. But at this point, it's embedded in the business. It's a bunch of intangibles. You basically have $20 billion in intangible assets. It is going to drag that number, but that's not really the important metric. What it means is, what is the underlying business going to earn? What I would want to do as a shareholder, though, is study those acquisitions and figure out if those acquisitions are going to give us a return, what we're really getting for that cost. Because you put a lot of money out there. Are they credible for this business? Are we going to have write-offs later? I really don't want to see write-offs because that would mean they made a bad price, made bad purchase price. And that's always a problem with these type of businesses. They want to keep growing. They make acquisitions that won't necessarily hit the bottom line very well. Now, we have seen cash flow from operations triple in the decade. That's a pretty good rate of overall growth. So I like seeing that. You also see the net income triple, so you're getting a good balance there. Now, stock-based compensation is kind of crazy here. You started at $200 million a year. We're up to $1.7 billion a year in stock-based compensation. They've been buying back shares every year, and it's made very little progress in their overall share count. And a lot of this is because the stock-based compensation is egregious. I mean, you have a huge amount of stock-based compensation on the size of this business relative to their net income. So that means that, not only are you paying a really high PE ratio, but a lot of that PE is being eaten up by share comp. I mean, They did $2 billion in buybacks, but they gave $1.7 billion back to employees. And that $2 billion in buybacks is like 80% of the overall net income for this business. So this business is basically being run and owned for employees. Now, this is the big red flag for me. I see this with a lot of software companies. Compensation paid to employees is a significant part of the business. It's very hard to get away from. But what I would want to see as a shareholder before I buy probably is I want this stock-based compensation number to go away. I'd really like it to go to zero. I'd like them to change their compensation scheme because this is eating away at the turns of shareholders, and it's particularly egregious when the stock price is this high because what that means is that's going to be a huge portion of the overall yield of the business. If the stock price was a lot lower, it would be less of a problem because of how much that would be. But again, it looks like the employees are really getting all the benefit for this business. You see dividends being, much lower than the stock-based comp. So, if you think about this, stock-based comp, 200 million, dividends, 200 million. Stock-based comp, 250, dividends, 280. And then you get to these other layers and stock-based comp has now doubled the dividends. So what that tells me is that shareholders own 33% of the business and employees own 2/3 of the business because they're getting paid more in stock-based comp, twice as much than what you're getting paid in dividends. That's a big concern for me. So you see this $8 billion in acquisition costs here. And of course, it's going into those acquisitions that I mentioned. They're also issuing some shares for that. You're being diluted. Intuit's tough here. What I would say is this is definitely a watch list company for me. It's a very high quality business. It's growing at a very strong rate. The underlying returns on invested capital are very strong. They're very nice. You have very good double-digit EPS growth. Anytime you have double-digit EPS growth, it's attractive. The only thing that I don't like here is the price is too high and stock-based comp is too high. So I would get interested in buying this company probably if the stock-based comp would either go away and the PE ratio becomes a lot more attractive. Once you get in the 15 range, 20 range on a PE, this becomes a very interesting stock, especially if management changes their stock-based compensation strategy. I don't think that's likely, but it's always possible, which means it's a great sort of stock for my watch list. If you enjoyed this video, if you learned something, hit that like button. Don't forget to subscribe. And if you want to learn how to use this software yourself, quickfs.net. My affiliate link is in the description below. Please consider using my link. If you do, I can get a commission for sending you to them. Free and paid accounts. I hope you'll check them out using my link. Thank you for listening, and until next time, stop paying fees, start building wealth.